Hello and welcome. I am Piers, CEO of the decentralized finance protocol Radix, a public layer entirely focused on bringing DeFi to the mainstream. This is our podcast, The DeFi Download, a show about decentralized finance and all things crypto, where we dive into the details of the projects, assets, and services that are powering the DeFi revolution. Today, I'm joined by Alfablok and Buendia, contributors to the Potion project at Potion.Finance, a risk management layer for DeFi, a way for people to manage the risk of their crypto and DeFi positions and manage the volatility inherent to the space. Guys, thank you so much for coming on the show.
It's a pleasure. Thank you for having us.
Thanks a lot, Piers.
So let's just start off with, where did the idea for Potion.Finance come? And what's happened since you first, what was that initial insight that you guys got to the space that meant that you wanted to build this so much?
So it all started, I believe, with the attendance to a seminar by Nassim Taleb in New York. He runs this thing called RURI, Real World Risk Institute, I believe it stands for.
Okay.
And it basically, it's a seminar on how people should think about risk taking.
Okay.
And I was really interested in how to manage the risk in my portfolio, like a traditional portfolio. And in the past, you do risk management through basically diversification. Modern portfolio theory is about, if I combine different assets with different volatilities, then my overall portfolio will be risk managed like this. And he kind of has a different point of view. He thinks that you should take more active risk management.
So let's dive into that, because there's going to be some listeners who are going to be like, I don't know what modern portfolio theory is, right? So modern portfolio theory, if you can just give a quick summary on where, what's the current thinking around that in traditional finance, and why diversification is such an important concept.
So this is something that was crafted by this guy, Markowitz, and he ended up winning a Nobel Prize for it. And I think it's kind of been the bedrock of risk management for a long time. But this is now dating, I'm not sure, but the 60s or something, some time ago. And the idea there is quite simple, which is that there is this risk-reward space, and
1952.
There you go. So even before that. And so the idea is that each asset, you can think of it as having some volatility and producing some return, right? So if you think of it like a map, it has two coordinates, the risk and the return.
Right.
And his big insight was that if instead of taking one asset, you take a basket of assets, something really special can happen, which is that you can go kind of left on the map. You can have less risk without sacrificing reward. And that's kind of the holy grail in risk management, that you want to have as little risk as possible with as much return as possible.
And the key insight for Markowitz was this idea of covariance, right? And in essentially minimizing the covariance of the portfolio. Because if you have covariant, which means that two assets move at the same time, if they're highly volatile but covariant, you actually don't reduce the risk of your entire portfolio, right? It's this idea of finding assets that have the similar risk profile that you want, but fundamentally that have a different variance in the market, so that when you add them both together in your portfolio, ideally if one's going up and the other's going down, they cancel each other out, and you don't.
That's right.
With this,
exactly.
You reduce the overall variance of your portfolio.
That's correct. You want uncorrelated assets, and if you can get uncorrelated assets, which obviously you have no guarantee that they will be moving forward, right? But if you have you make the assumption that some assets are uncorrelated, then you can cancel out the variance without sacrificing the return. And so that's kind of like the gold standard in risk management for a long time. And if you buy books on risk management, that you're going to learn about modern portfolio theory. But Taleb says that this is kind of obsolete, and that it has flaws in many dimensions. To begin with, you don't know whether assets will be uncorrelated moving forward, right? So a lot of the assumptions that are used within modern portfolio theory, may not be sound. And he basically teaches that there is this massive risk one should be aware of, and that's the risk of the black swan, or the tail risk, that there are some events that have very, very low frequency, but that when they happen, they're massive in nature. So like very, very negative returns, for example.
Right. So it's like saying basically, look, it's nice that these assets in the normal economic conditions are not correlated, but come a massive external event or like massive market crash, I'm sorry, but everything's correlated and your whole system of like risk management is messed up, because what actually doesn't matter is the small variance. What actually really matters in terms of a portfolio's return is these large variance events that happen less frequently than the small variance, which means that the Markowitz portfolio management sort of like covariance model doesn't, by the law of averages, doesn't work it out, right? Because you have like one massive event and then over 4 years you have like little events. So your averages moves that like massive event to like a tiny proportion of the total results, but actually it has this outsized effect on the portfolio, right?
That's completely right. And the idea is that one event, like you may be managing your risk really well for the 4 years, but in that one single event, you may lose 70% of your assets, which is basically not doing any risk management, right? And so you want to manage your assets in such a way that you're resilient to those events. And actually, he speaks about anti-fragility. You almost want to benefit from those types of events. Mm-hmm. And the way you achieve that is basically by getting into active risk management, which is basically having active coverage of your position through options, for example, like put options.
Right. And I just want to say an extra thing here, which I think is important, because a lot of people, like in crypto at least, talk about this thing of like weak hands and like strong hands, and like, oh, well, if there's a massive risk event and the market goes down, just hold the position. The thing is that often what happens is these massive economic events are correlated with need, like with personal need, especially for companies if they're treasury management, especially for individuals if suddenly there's an economic downturn, you lose your house, or for funds that actually have to sell out of a position. So it's not a factor of these stocks and shares and whatever will recover. Yeah, they probably will, but actually these massive outsized events can have this issue that you're now massively underwater. And because of the economic situation that is external to this, you're actually in a situation where you have to sell underwater. You have to realize the loss. If you're a fund manager, people are doing withdrawals or redemption claims, and you have to be selling these assets underwater. If you're an individual, you've lost your job, you need to actually sell out so that you can live. Like all of these massive events are often correlated with upsets in the economy as well, which means that cash on hand suddenly becomes important at the same time that assets have gone underwater. So holding the asset isn't often an option.
Correct. And also it just takes a lot of effort to recover from a severe loss. So like if you lose 70%, it doesn't take a 70% gain to go back to where you were. You have to actually do many multiples of that. Mm-hmm. And so you basically want to avoid as much as you can, these types of scenarios where you have very severe losses.
I never thought about that, but you're right. Yeah, I've got 70% loss, then I have to 2.2 times my original, my position that I've reduced to.
Yeah, something like that, almost 3 times. Yeah. So it's asymmetric. It goes one way on the downside, for you to neutralize your loss, you need to go 3 times up. So you basically don't want to be in that situation. And right. And so that's kind of the starting point. I'm kind of thinking, oh gosh, so how do I manage my own assets? Mm-hmm. So that I cut my exposure to these black swans or kind of these tail events, Mm-hmm. And this is, I think, somewhere around like the tail end of 2019. Mm-hmm. And we see open come into the space and we see hedging. And that gets super, super exciting because these guys are offering option platforms on DeFi. Mm-hmm. And that's like, okay, so that kind of starts opening the door to active risk management on DeFi. So I can protect my crypto holdings against these very massive events, which, by the way, are a lot more frequent in crypto, like a 70% drawdown on the S&P 500.
Casual Monday.
Yeah, exactly. That's your regular week, in crypto, especially for some altcoins. And so it just felt like this would be incredibly interesting and exciting for the crypto community.
Right.
And then the lockdown came along. This is now March, and we see this hackathon taking place from ETH Global. And Aureliano and I joined it with a simple idea, which was to create like a permanent hedger. The idea being that I would basically protect myself against this type of downfalls. And the idea was we wanted to simplify it such that a regular person without very sophisticated financial knowledge could just basically put their collateral in some smart contract, and then the smart contract would create the risk protection that would basically insulate that capital against these losses.
So can you give me an example? Like hedging is one of those things that a lot of people throw around the term of, and I don't think is always completely well explained. So like, what does hedging a position actually mean? Like what can you give me a worked example of a hedged position?
So a hedged position is you have, for example, one ETH, and you have a put option on one ETH.
And what does it mean?
So it means that, so maybe we should describe what a put option is.
Yeah.
A put option has several parameters. The more important one is the strike and the duration. Okay, so right now Ethereum is at about $1,800. So I could buy a put option with strike $1,500. And what that does is it kind of puts a floor to how much money I will lose on one ETH. So if one ETH goes to 1,500, then that option is still worthless. Like I haven't made any gains. But the moment that I go below the strike, so the moment I go below 1,500, then I'm start getting rewarded. Like that option starts getting value, and I'm able to exercise it. And it just creates a financial contract that means that the lowest price effective to me for Ethereum now becomes 1,500. Even if it goes down to zero, I'm always able to sell at 1,500.
So I always go back to the CFA definition of calls and puts, which is a right but not obligation to buy or sell an asset at a prearranged price within a prearranged date range, right? So like,
correct, yeah.
With this, what you're saying, a put option is a right to sell, right? And your strike is the price at which you have the right to sell it, and your duration is how long that lives for. So let's say it's a 1 month put option at 1,500. So the price now is at 1,800. Spot price of Ethereum is $1,800 per ETH. And what you're doing is you're buying the right to sell one ETH at $1,500 for a 1 month period. So you're paying someone who is promising to buy from you. So you have a price of the option. So let's say it's going to cost me $100. I have to pay someone. I'm saying right now at $1,800, you will buy from me over the next month Ethereum for $1,500 if I choose to sell it to you. And what you're saying, the reason it's worthless is because it's worthless all the way down to $1,500. Because if the market price for my ETH is $1,600, why would I sell it to the person that I bought the right to sell it to for $1,500? Right?
That's right.
And actually,
that's exactly right.
And actually, it's still worthless at $1,500. It only starts to be what is often referred to as in the money once you've also taken into account the cost of the option as well, right? So it actually only starts to be worth anything at $1,400. Well, as in like I'm starting to make a profit at that point.
Correct. That's exactly correct.
Right. So, and more generally regarding hedge positions, I would say that what one is looking for when hedging a position is basically to make some profit or just minimize the losses no matter the direction of the underlying price, right? So you have some security and you don't care, well, you don't want to expose yourself to a directional risk. So basically you sell part of your potential profit to reduce the directional risk, right? So that sometimes includes more general. Well, it has a whole bunch of possibilities like options or, long positions, short selling, things like that.
Right. Because you also have this whole thing of like, well, a option is in many ways a realized cost. I'm not going to say a realized loss, but a realized cost on a costless position. Like I'm holding ETH.
Yeah.
but I've now had to pay $100 to cover the downside risk of this ETH for the next month. So that's now making my costless position into, there's a cost to carry. And so this is where you start to do things like sell a long option to offset the price of the short option and stuff like that, right? So I can sell some of my profit, as you're saying, some of my upside. Let's say I sell my a long option at $1,200 for $100, and I use that $100 to buy the put option to save myself 1,000 from 1,500 downwards, which means that if it moons, I get up to 2,200, and then everything else I have had to give to someone for the next month. And if it falls like a stone, I'm at least covered up past $1,500.
Yeah, exactly.
Right. And I think some of the listeners may be like really well versed in all that stuff, and some of them may not. And this may sound like an insurmountable amount of complexity to get to grips, right? And that's exactly the problem that we wanted to solve. We wanted to create a smart contract that would take away all the complexities from having to understand how to select the strike, what is a fair price for that premium, and so on, and that it kind of happened magically in a way that was trustless. In a way that you could inspect the contract and be confident that what was happening was fair for everybody involved.
So how do you do that? There's a big challenge.
Yeah, definitely. And but anyway, like for us, we were in lockdown. We didn't have much to lose, and it just felt, to be honest, I mean, those days felt kind of magical. Like there were still very few people in the space, and you could just jump into any Discord and be talking to the founders. And you could, like, I think the crazier the idea, the more people got excited. So we wanted to build this permanent hedger, we called it. It's this idea that I put my holdings, and then I have like I don't need to be babysitting my position. It's like the smart contract is doing that for me. And so the idea was we were going to build this with either Opin or hedging, one of the two. And we actually were talking to both of them, which were like a huge inspiration for everyone in the team. And what it turned out was that it just was not going to work, because if you think about a permanent hedger, you want to have almost like an open-ended expectation that there will be somebody making a market for you. Like whatever option you need in the process of having to hedge the position, somebody's going to be there selling that option to you. I hope that makes sense.
Yes.
And
so you always need a maker in
correct.
You need a maker and a taker to be able to, because because of the duration, like whatever the duration it is, it has to close out at some point, and there has to be a settlement as well.
Yeah, and so the idea was, like, if you think about this, like I'm permanently hedged and I'm buying 30-day durations. That means that every 30 days I need to rebuy some new options, right?
Right.
And I have no idea in 2 years' time what the strike price will be. And so I just kind of need to have a counterparty that I can rely on, that I know will sell me the option I need, and neither Open nor hedging had this model, and it just felt it wasn't scalable, and it was not very well suited for this type of robot trading algorithms that we had in mind. And that's when the idea of Potion was born. Like we decided, okay, so we're going to try and build one protocol that is general purpose, that it's basically able to use whichever liquidity is inside to sell as many different option configurations as possible, such that a permanent hedger, like the one we had in mind, was going to be able to rely on the counterparty.
So if I read that back to you in like how I understand what you've described,
Sure.
What you're basically saying is, look, there are people who are willing to sell options because there's a profit in doing so. Mm-hmm. And there are people who need options. And the traditional way of doing it was essentially to say, well, I need to know, before I can provide my capital to buying or selling an option, I need to know what the asset it is that I am going to be actually taking the other side of. So I have to actively decide, as a option seller, someone who's providing the service, giving options, I have to constantly be in market and constantly making decisions on whether or not I want to be providing sort of this duration, this strike price, or whatever, based on my own view of risk. And I would like to talk about the Black-Scholes-Merton model and Kelly criterion, later on in this call. But like fundamentally, I have some models for working out what I think is the right price for an option. And so that's how the traditional model works. But what you're saying is, look, actually what there is there's a bunch of people who want to make money selling options. That's their thing. And they have a criteria for doing that, but they're generally happy as long as it falls within that criteria to sell those options. And then there's another side of people who actually want to hedge positions, but they can have radically different portfolios, and creating a discrete market for every single one of those assets is really difficult, and really difficult to create, like to get a threshold of liquidity for being able to do that effectively and guarantee that there's always a position to take that option. So what we need to do is fundamentally think about how we create these two sides of the market differently.
That's completely right. And we just wanted to do something that was kind of more sustainable long term for both parties, so that they could have this kind of permanent hedging or permanent selling, like this idea of I commit my capital to some smart contract, and then that capital is risk managed on my behalf on a consistent basis, so almost like trying to transition these markets from very active, very professional type markets to very passive, very non-professional, but equally sophisticated, and I think that's kind of one of the powers that smart contracts can deliver.
Yeah, and it's worth highlighting that in these last minutes, what we have introduced is the need for risk management for these sellers, so of options. So at the beginning, we were chatting about how the buyers of options were doing that basically to risk manage their positions. And now we're reaching the conclusion that to get these other actors, these sellers of options, to sell options passively, they need a risk management protocol embedded in the way they sell these options.
Right, because if you think about, and which you have, but like if you think of options, if I'm the person who is selling options or even buying options as my main thing that I'm doing to create a return on capital, I'm just taking bets, right? I'm taking bets, discrete bets on what the price of an asset's going to be at some discrete point in the future. And for me to be able to not, like for me to be able to make money long term, the value of the bets has to be more than the losses I sustain against those bets. And I have to be able to stay in the market for a long period of time. And if I take too many big bets, even if my betting process is right, I may end up losing all of my capital and lose the ability to take any further bets and actually like push me out of the market. So as I get closer and closer to my capital limits, I need some way of managing my risk to make sure that a black swan doesn't wipe me out in the same way that it doesn't wipe the people who are holding the collateral that they want to hedge against in the first place aren't wiped out, right?
Correct. And this is a tough problem. This is a very tough problem to tackle, but that's exactly what we decided to work on. And so just kind of continuing with the story, we decided that, okay, so if we want to build a protocol that is reliable for the LP side, for the liquidity providers in this scenario are the sellers of the options. They are the ones that are collateralizing the protocol so that options can be bought. We need to find some way to price those options such that it generates some safety net for the LPs, or some kind of expectation that they will not go bankrupt. Because if we want to do this passively, we can't rely on the LP kind of be fiddling with the prices. We want the smart contract to set the prices for them. And I think that the initial candidate and what we shipped for Hack Money was what we called a perfectly priced Black-Scholes machine. And this basically was we were really excited about it, and it was like a new way to price protocols that was back-ended. So you didn't know what the price of the option was going to be until expiry. So the idea was the users kind of put in a deposit that should cover like a very large premiums. And then once kind of volatility takes place at expiry, you measure what volatility actually took place, you plug that into the Black-Scholes model, and then you know the fair volatility, and that's the price of the option.
Right. So you're actually, what you're actually doing is you're actually pricing based on what actually happened, and at the end,
Correct.
you think, oh, this actually happened, and the fair risk price for this was this.
Exactly.
Okay. Yeah. Clever.
Exactly.
Yeah. There's a nice question here. Like, why would a seller agree on doing that, right? Or why would a buyer agree on doing that? Yeah.
I mean, the answer is that is the same thing as what's wrong with Markowitz, right? Is that the Black-Scholes-Merton model uses the standard deviation across a period of time. So if there is a single large event and the option is a long-standing option, you're going to actually get an incorrectly priced option based on a long tail event that happened in that period. So even what I'm guessing here is that the perfectly priced Black-Scholes-Merton model came out with was in large long tail event cycles for a sufficient duration. You actually got a position where the perfectly priced option still meant that the option seller lost money.
I mean, you're explaining the protocol much better than we are, but that's exactly right. So
I'm glad that's right. I worked it out.
Yeah, you got it 100%. So we actually can. So we're really conscious about, if we're designing a risk management protocol, like, we need to be sure that it kind of works. Like, if people are going to trust the protocol to manage the risk, it better be doing its job correctly. And so we built this simulation laboratory where we basically backtested a ton of scenarios for what would the experience be for an LP that puts their capital in the platform and leaves it for 5 years, 10 years, 20 years. We wanted to get a feel for what was the risk they themselves would be facing when using perfectly priced. So this is like, if you had full visibility over what volatility would take place and you priced every single time with zero error using Black-Scholes, what would happen? And that's what on screen now. We tested different assets. So you see Bitcoin, Ethereum, Chainlink, Maker, and then the S&P 500, gold, and the Turkish lira. We actually, like, some people from the Turkish community came to our Discord because they're really keen on having something to hedge their currency in DeFi, Right. So we decided to put it on our benchmarking test. And what you can see is that the picture is really nasty. Like, you can see the drawdowns of 95%, 100%. So this is like, you go bankrupt within 5 years if you're consistently selling options. Once again, with zero estimation error, like, you're following the Black-Scholes model to the T, and you're still going bankrupt. And you can see that kind of this phenomena is very different in kind of traditional finance assets relative to crypto assets. And you were already alluding to this. This is because the Black-Scholes formula is based on this assumption that the distribution of returns is normal, or it's kind of thin-tailed or Gaussian. And the example I normally give is, this happens a lot in nature. Like, a lot of phenomena in nature are normal. Like, for example, the height of people. Like, you have a lot of people that are around 1.7 meters. That's kind of the mass. And then you have less and less people as you go away from the 1.7. And maybe you have a few people in the world that are 220. Maybe some people, I don't know how that is, 7 feet. I never know the American, but like, but you don't have 3 meter people. Like, you don't have 4 meter. They just don't happen in nature. Right. And similarly, you don't have 5 centimeter people. And this is kind of a big problem, because in crypto, you do have 7 meter tall people, and you do have 10 centimeter people that happen with, like, worrying frequency. And these are kind of these black swan events that we've been talking about. And that's why you see that for assets that kind of behave more in keeping with a normal distribution, the risk is kind of better managed. But the moment you step in crypto land, then you're in trouble. And so that was a problem, like, we basically saw that even though Black-Scholes is kind of the gold standard in option pricing, and even though we had come up with a way to do perfect pricing on Black-Scholes, we just have to look for something else. And that's where Kelly criterion comes into the picture. I don't know You
So
want
I
to
do,
now,
I
or?
do, I do have a couple of questions about this, which is sort of interesting, right?
Sure.
It's like, if this is true, right, and the constant selling of options on the S&P, gold, and the Turkish lira, all of which do have liquid options markets, then how does the traditional financial system currently deal with this? Because obviously, people who are selling options are not making a constant loss on the S&P 500, gold, and Turkish lira.
First, I should clarify that this is not talking about the loss. This is talking about what's the worst drawdown seen. So the maximum drawdown is over. In this picture, we're looking at
sure.
5 years worth of trading. So this is saying what's the worst, like the lowest balance.
Got it.
Let me start over. In the simulations, we assume that the LPs were starting with $100, and then we just run thousands and thousands of simulations.
Right.
And for every single simulation, we looked at what's the lowest balance that was ever observed during this 5-year period. We could also look at 10 years, whatever.
Got it. So this is not actually the loss position unless you get to 100% and then you're out.
Correct.
Or unless you get out of the business of selling options when you have this 95% max drawdown, and you make it permanent. Yeah. It's like an impermanent loss of a sort.
Right. A new type of impermanent loss.
Yeah, correct. Yeah.
Okay. All right. Cool. Understood.
But I to answer what you were saying before, like I guess in traditional markets, like the option sellers, they get this active approach. You know, they have their own internal strategies, and they decide when they're selling and when they're not. And by this filtering is basically what allows them to have profitable strategies. Okay. In these simulations, we're assuming that the seller is always selling, like is always open, and there's always demand for that, and that's what causes these numbers.
Right. Okay. Got it. So where did you go from here?
So we went into a place of pain because we didn't know what was going to happen, and by that time, like some excitement had gathered around the project, and there were some people that wanted to help us kind of bring this to life. But we kind of had evidence that this was not going to work, you know, and we didn't want to launch a protocol that had these kind of figures behind it.
Right.
But then
great for the option buyers.
Yeah, correct. Exactly right, but not great for the sellers. And I mean, that's one of the things in crypto. I think like the protocols that are long-term sustainable are those that create kind of the selling point where both sides of the market have a reason to be there, you know, and have some chance of making some money. Maybe not a crazy amount of money, but you want the other side of the party to not go bankrupt. If they do, that's also bad for you, you know, like you're not going to have anybody selling anything to you.
Right.
And so
it's actually, not a zero-sum game.
No. Ideally not, yeah.
Right.
And then Taleb also kind of gives the answer for how should you actually do risk management. And he talked about the Kelly criterion, which maybe just to introduce briefly as well. So here is this guy, Kelly, and he was a researcher from MIT and was working at Bell Labs with this gentleman, Claude Shannon.
Claude Shannon's amazing. I mean, if just as for the listeners, if you haven't actually read up about Claude Shannon, he's probably one of the most spectacularly clever people in information theory and computer science. Like, he's just unbelievable. I'm like a little bit. I have a little bit of a geek crush on him. Is amazing. So yeah, just Claude Shannon, yay!
yeah. He's the man. You know, he's one of those geniuses, and like a genius for a long generation. You know, he's the father of information theory.
Right. You could argue he's the father of modern cryptography in many ways. Like his work on sort of randomness it still forms the basis of many of how our cryptography algorithms work. So yeah, like
Right. And so these guys were collaborating, and this is like a nice person to be working with, if you can, Shannon. And he basically tried to answer a very easy question, which is that if I'm offered a positive odds bet, so if I'm offered a bet where I know that I have some edge, like I know that statistically speaking, I have an advantage, is there an optimal amount that I should put at risk from my available capital, basically, right? And it turns out that there is, that it makes a difference. It's not the same thing if you bet 10% of your holdings than if you bet 90% of your holdings, than if you bet 100% of your holdings. And this is the shape that it has, like if you bet, and I should add, on a dynamic basis. So this is not a one single bet, but a bet that you're expected to repeat over and over and over and over, right?
Right.
And so the idea is that if you are taking risk and you put all your capital at risk, it doesn't matter if you have a positive edge. Like you can say you have a 9-to-1 chance of winning. And if you win, you double. And if you lose, you basically go to zero. If I do this bet enough times, eventually I'll go bankrupt. Like maybe I'll keep doubling 3 or 4 times, but then at some point, some bet will go against me and then I'll lose everything.
All right.
So
I mean, like, would it be right to put it in this way? So I have 100 coin tosses, and each time a hedge comes up, then I win 1.25 times my money. And every time, whatever I betted, and every time a tails comes up, I lose whatever I betted. Like not my whole money, but whatever I betted. And the question is how much capital of the pot that I have, should I allocate to each one of these coin tosses over the full 100, right?
Correct. With a big caveat, this is talking about an unfair coin toss.
Yes. So, So heads 1.25 times the money I bet, and tails, I lose my money. So if I've got $100 and I put $1 on it, at the end of a bet, I'll have $1.25 if I won, and I'll lose $1 if I lost. So over 100, I should be able to be up, right? I should be able to be up 17.5% over it, statistically speaking, right? I think that's right. But so it's unfair advantage to me, but if I bet all of my money on just one coin toss, I could lose it all. And so it's not the right amount to put $100 on one coin toss. I need to put some subcategory amount of my capital, right?
I think there is a nuanced distinction to make here. One is, what are the odds of the process? Like when I flip a coin, like do I get a 50% times tails and 50% of times heads? And he basically is only dealing in the world where you have favorable odds. So like, forget about the payoff.
Okay.
Just the inherent process is kind of sided towards you. Like,
so 60% chance of heads, 40% chance of tails. How much should I put on each bet? Okay, got it.
Correct. Right. And he basically says, you should not put all your money ever, right? Like the expected growth rate, and growth rate is almost like the compounding rate or the alpha. So how much your money is compounding over time. This varies as a function of the percentage that you're going to put out of your stash. So if you had 100 coins and you put 100% of the coins every single time on that bet, over time, your expected growth rate is basically going bankrupt. And so it kind of divides your allocation space into 2 areas. One area which is you're over allocating, and then one area in which you are under allocating, and then one very special area which is the optimal fraction. And this optimal fraction, he makes some really intense claims about. It says there is no other strategy that delivers a higher growth rate for the amount of risk that you're taking, which is an incredibly powerful statement to make, So this is kind of what Kelly does, and poker players and people that are in the gambling space know this very well. And in fact, this has been proven to work in practice. And I think there is this guy called Thorpe that famously, I think, won something like $800 million betting against the casinos using this strategy. So he was waiting until a situation arrived where he had positive odds, and then was using Kelly to decide what allocation to use, and he basically made money. And Warren Buffett uses it, James Simons, Nassim Taleb. Like it's not something we've invented at all. It's like a well-established risk management discipline. But it doesn't say anything about option prices. Basically, it just talks about optimal allocation of assets. And so the big idea here was, can we actually use the mathematics of Kelly to produce a bonding curve that we can use to price options? And this basically made us do something. And by the way, like if this is not making entire sense, like by all means jump in. But this is kind of how the Kelly criterion works normally. You put the premium, you put the payout rules, and you supply the odds. You put it into the mathematics, and then it spits out, that's how much you should bet.
Right.
And so our challenge was, can we actually use this backwards? Can we start by saying, this is the order size that I'm taking. So I'm an LP, and somebody comes to me and says, I want a put option that comes with strike $100. So it's almost like, to begin with, somebody saying, I want 10%. If let's say I have $1,000 position as an LP, somebody comes along and says, I want to take $100 of your capital. So I kind of know already, this is 10%, right? So can I do something so that I make the 10% F star? Can I kind of reverse engineer Kelly to make that the answer, the order size that I'm being asked? Right? So, and can I kind of isolate the premium as the only variable that I leave available, so that I kind of can work Kelly backwards, and that from an order size, I get a resulting premium.
And just to make sure I'm following, the reason that this creates a bonding curve is because the more of your capital that you have allocated to bets that have not yet actually come out as whether or not they've won or lost, the more you should be charging, more of a premium you should be charging to make sure that you don't end up in a situation where you're bankrupt on your bets.
Yeah, I mean, and that's exactly the right intuition, which to us made kind of very intuitive sense from the start. If you have more capital at risk, like as you start going higher and higher in utilization, then your risk of a black swan manifesting and kind of going against you becomes higher. And so the higher your risk, it kind of becomes intuitively sensible to increase the premium, so that by increasing the premium, you're automatically reducing the risk, right? Because the premium is money in the bank. You're not going to lose the premium, right? The premium is safe money. And to the point where you almost want to go like really high as you go to very high utils, to make sure that you're going to be able to survive even in the event of high losses.
And the reason that you never go to 100% utilization is because the Kelly criterion basically says never do that. Like you have to always be on the active bets that you have. You should never have your 100% of your money allocated to the active bets, so that the bets either pay out or they don't, you then have a renewed pot of money for which you can then allocate based on this bonding curve. Is that the right intuition?
Yeah, this is definitely the right intuition. Like Kelly wants you to bet in such a way that you will always have some capital remaining, so that you can kind of grow back up and survive. Like Kelly wants you to survive. And all the mathematics around Kelly are about maximizing this growth rate. And if you have a positive growth rate expectation, then almost by definition, you're not going to go bankrupt. And it prevents bankruptcy, because you're never going to go to zero, because you're never fully exposed.
Right.
You always have the premium. And so even though you may suffer some losses over time, you're recovered. And actually, we saw this in the lab. Like we tested all of this, and in a few moments, I think you'll see this visually, how this works in real life. And also, just for people who are not familiar with bonding curves, for me, this is like a very simple intuition that it almost gives me like a way to price things that is autonomous. So I don't need to go and ask some oracle for how much should I be charging. Much like Uniswap or Balancer, like when I'm doing swaps between ETH and DAI, Uniswap is not going out and asking Coinbase or asking CoinGecko, Uniswap actually makes the price emerge directly from internal variables. So it has these two pairs, and it looks at what's the ratio between the two pairs. And then according to that ratio, there is this mathematical formula that spits out a price. And And so here is the same idea. I'm just looking at some internal variable, which is utilization. And just looking at utilization and utilization alone, without having to go outside the smart contract, I'm able to produce a price, which is kind of really interesting, right?
Yep.
And then the question for us was, okay, so what is the optimal bonding curve? Like, I'd love to do this, but I'd like to find what is a bonding curve that makes the LP survive. Right. And that's what the criterion gives us. It gives us a way to work out what's this bonding curve.
Right.
Yeah. So what you do with what you described before, this reverse Kelly thing, you would go in, you see these pink dots here in this curve. So you would go for each of these dots. Okay, what's the utilization? That means what is the bet size that the buyer would be asking for? I'm gonna plug this in this Kelly reverse calculator, and it's going to tell me like what is the premium I should be charging.
Right.
And by doing that, I can basically draw these bonding curves.
Yeah.
Right. So obviously every single person is going to be at a different point in their utilization, right? Like some people are going to have been in there for longer, so they've sold more options. Other people have only just joined. So how do you create an emergent pricing model from that?
Yeah, you're asking all the right questions, man. So
almost like I did my research before we had the call.
Almost. Right. Yeah. So basically, there is this router that basically sits between all these pools. So each LP has its own independent pool with its own custom bonding curve. Like we will give some pre-made curve, but people can define their own if they want. And then the users will be on the other side of this router. And the router kind of looks at all these parameters. And from these parameters, they're able to calculate what's the cheapest possible route. Right. And this kind of creates like, we call it an emerging bonding curve, which is like this aggregate bonding curve that comes up from the entire universe of LPs in the network.
Yep. And what their stage of utilization is as well, right?
Correct. And what you can see here on screen is an animated version in Dynamics where you have LPs coming into the system, exiting the system, and orders taking place. And you can see that at any point in time, there is this blue bonding curve, which makes the users see the system as if it was one single large LP. You know, they don't need to understand the complexities or do anything like this. They just can trade with it as if it was a single system.
So we're coming to the end of the time that we have available. I suppose there's two things that sort of come out of this for me, right? Which is like the original problem was, how do you make this easy for users to hedge themselves? Like that, what we've spent a long time discussing is how do we make it profitable for people to provide autonomous risk pricing to people who might want to buy options, which is a related and important problem, but not quite the same problem. And then the other thing is at the end of this, does this create option pricing that people would actually want to pay?
So these are really good points. I think on the first one, this feels a little bit like a chicken and egg, like, but our view was you kind of have to solve liquidity provision first, because without liquidity provision, there is no service.
Right.
100%. And then once you've solved that, then you have a market that the users can come to. And then hopefully the system operates in such a way that the two sides of the market can kind of organically find the pricing that works for both sides, you know? And so that's why we've been super concentrated now on liquidity provision. But our long-term vision remains to kind of close the loop and provide this permanent hedging capability, which is not there in our development, but kind of that's where we're going, eventually. And the second question was whether the prices produced are market compatible.
Right.
And
is that the euphemism? Market compatible? I've never Okay.
That's how we talk about it. That's how we talk about it. And they are like basically we've looked at a number of assets, like assets that are heavily traded, like the S&P 500 and whatnot, and they cross, like they are in the bonding curve, like they're at some point in the bonding curve. So if you looked at the S&P 500, I think in our calculations it kind of equated to I'm talking off the top of my head, but something between 40 and 50% util. That's kind of where the market is pricing it. And so you can imagine that if people kind of take that as the reference and you say that that's how it's being traded in traditional finance, you would expect the system to become 40% utilized kind of organically.
Right. And that, I suppose that's the nice feature of the bonding curve as well, right? Is that it will at the start underprice Black-Scholes, and then over time, it basically just depending on utilization, you'll get a increasingly expensive, and you'll just find the market equilibrium price for things, which I think actually, like, just coming to some sort of conclusion here is the genius of DeFi. Like, the genius of decentralized finance is this ability to create a market aggregated risk price that is at a constant equilibrium between the people who want to buy one side and the other people who want to sell the other side, that is dynamic, and like it's so completely different from these like discrete financial products that we create in the financial sector, in the traditional financial sector. And I think that that's what makes these things so exciting and so powerful, because what did you call it? Market compatible pricing. That's such a good euphemism. A market compatible pricing. Like it sort of doesn't matter. Like, the way that this works is that it makes sure that it always starts off as market compatible and finds an equilibrium point. The market compatible pricing is really whether or not the starting point is too expensive. But if it's not, then this has got a really good chance of being a fantastic new way of pricing options.
Yeah, and I totally agree. And just to build on that, and in closing, and we actually used this slide in our last community call to close. This is from Dan Elitzer, who he worked at Ideal, and he's a prolific investor and like a really strong member in the DeFi community. And he said the most successful DeFi protocols will be the ones that realize the truth, that they are not lending or exchange protocols, but liquidity protocols.
Yep.
Lending, exchange, futures, options, just starting points. What matters is sitting on the efficient frontier of risk and return.
100%.
And that's exactly how we think about it. Like, we want to create a protocol that exposes this risk frontier and helps participants find it in a way that's simple and passive as much as possible.
Yep.
And the Kelly criterion just kind of helps us get there.
And I think that's fundamentally what the whole DeFi space is. Like, I always say, like, the function of the global financial markets is efficient capital allocation. And what you're able to do here is create dynamic, efficient capital allocation in a passive manner, which is just unbelievably exciting.
It's super cool. Yeah, it's necessary. Like, it really feels to us like we're trying to build something that's necessary, and whether it's us or somebody else, like, that's where we're going, and the protocols that will be successful are those that kind of get quicker and faster to these kind of selling points of market equilibriums.
Guys, it's been such a pleasure talking with you both. Thank you so much for your time. If people want to find out more about Potion.Finance, where should they go, and what should they be reading?
So the website is a great place to start. We have a Medium post that describes this in some detail.
Yep.
But above all, we have a Discord community that is quite vibrant and young. And we're just trying to create an environment where people that are excited about risk management can contribute and build together with us.
Awesome. Thank you very much, guys. Have a wonderful day.
Thank you very much, Piers. Pleasure.
Thanks a lot, Piers.